I guess the biggest takeaway here is that General Electric isn't General Electric anymore. With 3 specialized spin-offs, I guess the company's becoming Specific Electric. Hey everybody, Walrus here from Walrus Street, bringing you your news and earnings for the week of November 15th, 2021. Just a reminder, I am not a financial professional. All information in this video is for entertainment purposes only. We had a bit of a market pullback on the second half of the trading day, Wednesday into Thursday morning, and as a result, most of the major indices ended up finishing negative on the week. However, we are still, pretty darn close to all-time highs, so it's not like this was a huge retracement. This was just a healthy step backwards, although it would be much healthier if we went a little bit further backwards. But hey, that's another discussion. This week was a little bit light on the news. There was a lot of bad news about the CPI, about Evergrande. We'll talk about that briefly. There was some interesting stuff with some really big companies splitting up into smaller companies. And of course, there was the Rivian IPO. So let's get started with the Rivian IPO. This was, I think, the biggest news story of the week, not because it's a single company, because I think this has really shown how heated the market has gotten for new IPOs, for speculative plays, and this is frankly a little bit scary as an investor, and I would like to pride myself as being a value investor. You guys know I typically dig under rocks to find stocks that are values, but here we've got Rivian's $100 billion IPO. Rivian stock value rises above $100 billion on the day of its IPO. The EV maker does have over 55,000 pre-orders for its pickup, and it expects significant expenditures in the coming months as it works to ramp up production on its pickup and its SUV. The EV maker stock opened up at $78 a share on Wednesday and closed at $100.73 later in the day, representing one of the biggest opening day gains seen in years, propelling it past Ford and GM's market values. Again, I can't stress this enough. At the moment, Rivian is capable of producing about 1 vehicle per day. So the fact that they have a market cap that's higher than Ford, higher than Chevy, both of which are making EVs, and higher than Volkswagen, which is I think one of the best run vehicle manufacturers in the entire world, is just shocking and absurd. Now, I understand Rivian's going to be ramping up its production, and that's why it IPO'd when it did. It needs the money to help accelerate its production to move into the next phase of its business growth. I also understand that investing is forward-looking, but how far forward are we actually looking here? Is this valuation 5 years justified? 10 years justified? I think it's probably closer to 15 years justified. So why are we investing in a company's future valuation by 15 years from now? That just doesn't seem to make any sense to me. Although it's not like this is something that we haven't seen before. Even Tesla's valuation is silly, and I know people are always going to say, but Tesla's not just a car company. Yes, I know, but they do generate most of their money from car sales at the moment. So we've got Tesla sitting here at 7 times VW's market cap, despite VW outselling them in just about every metric, including the EVs. And here we've got Rivian passing VW's market cap, and Rivian's not really selling cars. I mean, their car sales could just be a rounding error compared to what Volkswagen puts out. So this whole thing is silly to me. I hope that anybody that's watching this video that did get in on Rivian pretty early did make out on it, and I hope you were able to flip it for some gains because the stock price is even higher than it was on the IPO day. This is the chart for Rivian. Opening day, we ended up coming in at $106.75, which was well above the IPO price of $78, so people were instantly in the green on that one. Ended up peaking around $135.20, closed at $129.95. On pretty low volume, we hit $132.20 after hours. But when I see these two candles right here, this looks like a trend reversal to me. We ended up hitting a top, high volume, ended up selling the shares down. There was another attempt to breach it, and we kind of just peaked off here, and the volume is getting really, really low. So I'm thinking this kind of $130 level is about the highest for Rivian, and then we're going to start coming back to earth. Couple of big semiconductor stories this week. Chipmaker AMD just scored a big deal with Meta. Every time I see Meta, I have to remind myself that it's Facebook. I think it's going to take a really long time for me to get used to Meta being Facebook, but yeah, I got to drill that one into my head. Meta, Facebook, Meta, Facebook, Meta, Facebook. Okay, got it. The chip giant said its EPYC chips were selected by Meta to help power its data centers at its virtual Accelerated Data Center Premiere event on Monday. AMD explained the two companies worked together to develop a high-performance, power-efficient processor based on the company's third-generation EPYC processor. The CEO of AMD said, "We're living through a high-performance computing megacycle that shows no sign of slowing down." And here's a pretty cool graph showing showing that AMD is at all-time highs amid semiconductor shortage. And I mean, really, we could just kind of pop any of the big semiconductors into this. I mean, Nvidia would be like this too if you take out the whole stock split situation. It just, the semiconductor designers are just killing it right now. This is just another positive story for AMD. It seems like every single week we talk about a huge new customer for AMD, a new partnership, a new deal, and they're just balling. I don't know what else to say. This is a phenomenal company. This is a phenomenal investment. And as Lisa Su said, there's no signs that it's going to slow down. I feel like AMD could just partner with anybody on anything. And once the semiconductor shortage actually ends and they're able to actually get out higher numbers of the chips for all these partnerships, they're going to be pulling in revenue hand over fist. Another quick look at the AMD chart. It just seems like yesterday we were down below $100, just the beginning of October, 6 short weeks ago. And right now we're sitting up here at 147, and this isn't even the peak. It peaked at about 156. This stock is just soaring. It's phenomenal to see. But it's not like AMD is running away with the semiconductor space. 9 governors press U.S. lawmakers to pass the semiconductor funding bill. A bipartisan group of governors from 9 states sent a letter on Wednesday to U.S. lawmakers urging them to pass subsidies for semiconductor factories that would produce chips for cars. The semiconductor funding passed the U.S. Senate earlier this year, 6832, as part of the broader U.S. Innovation and Competition Act, but it has not yet passed the House of Representatives. If you remember, we covered this one a couple months back, and this $52 billion, a lot of this is actually going to be going into Intel, investing and helping them fund the foundry and helping them expand their production capabilities. And the whole idea here is that the U.S. wants to be less reliant on Taiwan for semiconductor shortage, just in case something does happen with China and Taiwan over there and destabilizes Taiwan's manufacturing capabilities. The United States wants to depend on Intel inside the national borders. Intel inside? Got it? Okay, we're moving on. Next news story, Fed says China's real estate troubles could spill over into the U.S. With all of the U.S. banks investing into the volatile Chinese real estate market, no shit. Stresses in China's real estate sector could strain the Chinese financial system with possible spillovers in the United States. The nexus of the Fed's concern is that China's real estate activity is slowing, but the developers have large debts, and some of them are diversified into other areas of the economy. These wide-reaching links mean a slowdown in China's housing market could ultimately lead to unemployment, a drop in Chinese stocks, and deflation, which could spread through the global channels as China cuts its purchases of goods from other countries. However, such fallout is unlikely. China's government has been wrestling with high corporate debt for years, is alert, and has resources to deal with the real estate sector. So this is just a whatever thing. The Fed is warning that there could be far-reaching influences, and I feel like everybody already knew this. When one of China's largest real estate developers goes bankrupt, there's bound to be far-reaching effects to the Chinese economy and also through the global economy because China is so interwoven with commerce with everybody else. A lot of the big US banks like Citigroup, Bank of America, JP Morgan are heavily invested in China. So if there is a problem, we should look towards the banking sector to see how bad the problem's actually going to be. Like 2 days after the US issued that warning, Evergrande officially defaulted. DMSA is preparing bankruptcy proceedings against Evergrande. The Deutsche Market Screening Agentur, the German market screening agency, already recognized the default at the time and proved in a study that the bankruptcy of Evergrande, the world's most indebted corporation, could ultimately lead to a great reset, i.e. the final meltdown of the global financial system. Well, that's dramatic. In order to be able to file for bankruptcy against the company as a creditor, DMSA itself invested in Evergrande bonds whose grace period expired today. In total, Evergrande would have had to pay $148.13 million in interest on 3 bonds no later than today, but so far we have not received any interest on our bonds. With banks in Hong Kong closing today, it's certain that these bonds have defaulted. Well, we all knew it was coming. It was just a matter of time. We had to wait until we actually hit the default button, and this German group, DMSA, is the first one that's actually filing for bankruptcy proceedings to begin against Evergrande, but I'm not really sure how they're going to be recovering any of their money because nobody even wants to buy Evergrande's assets, what few assets it actually had. If you remember, they were trying to sell off their headquarters in Hong Kong and the buyer backed out. There's been a couple other stories about them trying to sell off global properties and people are just backing out because they know they could get the properties cheaper. They know they could get everything cheaper. So I'm not really sure what DMSA is going to be getting out of this bankruptcy case, but it is good that they're bringing light on the situation and holding Evergrande accountable. I think think it was a little flare on the dramatic side when the company said that Evergrande's collapse could bring a great reset on the global economy. I mean, I think it will be bad, but I don't think it's exactly going to be a great reset. I think most people did realize that China is a very risky investment, and people have been hedging their Chinese investments for the last year. So I don't think this is in any way going to be a great reset, but I do think it is eventually going to cause a market pullback. Next news story, General Electric is going to split into 3 public companies. The once mighty American manufacturer will split off its healthcare and power businesses. The plan is being unveiled 3 years after Larry Culp took over the troubled company and tried to stabilize its operations by selling off business units and paying down the company's debt load. But GE stock price, despite a 1-for-8 reverse split, has lagged behind the S&P and its rivals. The move is a culmination of years-long process of shrinking the company. GE has already sold off its locomotive and home appliances businesses. It spun off its oil and gas business operations. It has sold off most of its once massive financial services arm, which hobbled the company after the 2008 financial crisis. It also slashed its quarterly dividend to a token penny per share. What remains today are 3 businesses: aviation, healthcare, and power. The company will now spin them off into separate publicly traded companies. If you go back just a short 10 to 15 years, General Electric was in the top 5 most valuable stocks in the US stock market. The company ended up becoming so bloated and ridiculously stretched out that it was just no longer profitable. Look at the assets that they just mentioned they sold off. They sold off an oil and gas wing. Did you guys know that General Electric had an oil and gas wing? I sure didn't. They sold off their financial arm. I didn't know that they had a financial arm. They sold off their home appliances. Okay, I did know about that one. And really that just leaves them with their profitable core: aviation, healthcare, and power. So the company is splitting off into these 3 separate entities in hopes that by reducing its size, these 3 companies can be a little more nimble and able to grow at a faster rate than the company could with all 3 together. I guess the biggest takeaway here is that General Electric isn't General Electric anymore. With 3 specialized spin-offs, I guess the company's becoming Specific Electric. The chart's kind of hilarious. On the news of the spinoff, it actually peaked at around 116, and then everybody realized that this wasn't happening immediately, and the price ended up just dropping right back down. So I think people were really excited about the spinoff, and then, oh yeah, wait, this is General Electric. There's no reason to be excited about this company. In other news, we actually have another spinoff coming this week. Johnson & Johnson is going to be splitting into 2 companies to aim for faster growth. They're separating the division that sells Band-Aids and Listerine from the medical device and prescription drug business. Johnson & Johnson is peeling off a consumer health business that helped it become the world's largest healthcare products maker. The split, which will create another publicly traded company for the consumer health side, will make each business more nimble in adapting to their respective markets. Well, there's that word again, nimble. These companies get too large and they can't really manage themselves. And by becoming smaller, you can end up focusing and specializing on what you're good at. And that's kind of basic economics. You want firms that are specialized so they can actually be more profitable. The biggest question for me with Johnson & Johnson here, who gets the ampersand in the divorce? Is it Johnson or Johnson? Johnson & Johnson stock ended up having a similar move to GE's this week, where we had this huge volume candle, a spike, and then a retracement. The only difference is Johnson & Johnson's didn't give up all of its gains yet, so it is sitting about a percentage point above where it was. Now for the next news story, I gotta talk about it. It makes me sad, it breaks my heart. I gotta talk about Shift. Shift released its earnings report, and again, it was astounding. It was awesome, just like every other earnings report since I started covering this company. Shift grows revenue 200% in Q3 2021, raises guidance for 2021. Again, this is astounding revenue growth, and this is like the 3rd or 4th straight earnings report where they raised guidance. They're projecting 151% year-over-year Q4 revenue growth at the midpoint of the management guidance range, and management raises its full-year revenue guidance to $621 to $629 million, which is over 3 times year-on-year growth at the midpoint of the range. Not only did the company improve revenue growth, but they improved their operating leverage. The operational excellence of our team allowed us to effectively navigate through unique and challenging market conditions. Shift just breaks my heart. I feel like this is such a solid company, and even after this whole time, I think I'm right about this. I think that it is a good investment. The only problem is the price action is not following with what I believe and what I see on these earnings reports. I see them raising their guidance. I see them breaking their own revenue records, and it's still just the price action sucks on it. And I learned a lesson on this one. I learned a very valuable lesson. I ended up losing about 2/3 of my initial investment on the calls that were dated November 19th. Thankfully, I was able to close out of of those positions on Thursday on the IV spike and retain at least a third of what I originally put into it. But I still do have my commons position in the company, and it's not just because I'm bag holding. I actually still do believe in this company. I do have a couple hundred shares still sitting there, and I'm just sad about the way everything has gone. Their marketing is excellent. Their commercials are funny. They're expanding their operations in a really great way. Their customer service is phenomenal. They're still one of the top rated apps on the App Store in customer service. It just makes me sad. I guess that's it. And I know I kind of put on a pretty good face for you guys and I smile in front of the camera, but I really was pretty crushed about this one. And so I ended up going back through my trades and I was kind of just trying to justify, losing the amount that I lost in this one. And I realized that, I've made that back so many times over, and this is part of trading. Sometimes you have big wins and sometimes you have big losses. You got to keep your emotions out of it. If I let this shake my confidence, then I'm going to lose out on so many more opportunities going into the future. I'm going to keep on going. I'm going to keep on making the same analyses that I've been making, because for every single case like Shift where I've lost money this year, there's 4 or 5 more cases where I've made money. So I just need to kind of keep everything in perspective. If we take a look at the Shift share price, it just kind of dumped off here after earnings. There was a really big volume spike after earnings, but it was just a net negative movement. Everything about this just sucked so much. I was able to close out of my position because the IV was super, super high. The IV ended up going up above 200% on the day of earnings. Earnings was reported after market close. But if not for that IV spike, I probably would have been out more than 67% of my original money. Next news story, Monday.com announces third quarter 2021 results. If you guys remember, I talked about Monday.com last week and I mentioned that it was an overvalued company and my position hasn't changed, even though the price action this week was ridiculous. There was a 33% spike on Monday.com, which is a company that's sitting over $300 a share. So it ended up jumping up almost to like $450 a share. Incredible, incredible price action, but it ended up closing the week after the earnings at almost exactly the same price, dollar to dollar, that it started the week. So it was a net neutral week for Monday.com. We achieved another strong quarter of top line growth driven by rapid adoption of our Work OS by new customers, along with expansion with our existing customer base. Third quarter performance demonstrates that our platform's unique low-code, no-code technologies enabling more organizations to achieve their business goals by accelerating digitalization and creating a unified workspace. Revenue was $83 million, a 95% increase year over year, and they did just turn a positive free cash flow of $2.9 million, which was their first positive in that area. Now, superficially, all of those metrics do sound great, and I wasn't saying that this is a bad company. I was saying this is an overvalued company, and nothing has changed on my sentiment there. Let's take a look at the financial number breakdown. Remember last week when I was talking about this company, my major qualm was that it's a $16 billion market cap, and the revenue, even extrapolated out. Previously, it was like below 300 million. Now it's just above 300 million. So you have an annual revenue of just above 300 million for a company with a $16 billion market cap. It doesn't add up in any way, shape, or form. Net income was effectively the same. Last quarter, they lost 28.89 million. This quarter, they lost 28.85 million. I guess their saving grace is that they did have a net increase in cash and cash equivalents. So that's definitely a positive. They are 8 million ahead of where they were last quarter. So they haven't completely blown all of their IPO money out. I still stand confidently by what I said. There's no way that a company that's pulling in 300 million in revenue and has a negative net income should be worth a market cap of $16 billion. That IPO money eventually is going to run out, even though they were able to add to it. I'm sure they're going to have some expenses going forward that are going to be very large, and it's going to be eating into that money from IPO. So yeah, I'm sticking by my word here. Monday.com is going to be falling off. Next news story, US consumer prices jumped 6.2% in October, the biggest inflation surge in more than 30 years. Yeah, that's a lot. I mean, we've been doing like 5%, 5%, 5% for a couple months now, and it just jumped up 6.2%. This is big, and what's even bigger is if you factor out food and fuel, which are the two most volatile aspects of the CPI, the inflation is still at 4.6%. Energy, shelter, and vehicle costs led the gains, which more than wiped out the wage increase that workers received for the month. Again, let me say that, which more than wiped out the wage increases that workers received on the month. That's right, you're losing money even if you're getting paid a little more. On a monthly basis, the CPI increased 0.9% against 0.6% in the estimate. This is the actual report from the Bureau of Labor and Statistics. We have the all items index going up. We have all items less food and energy basically mirroring the same pattern. If we take a look just going across, food 0.4, 0.4, 0.8, 0.7, 0.4, 0.9, 0.9. This is getting pretty ridiculous. Energy is way up, and this has a lot to do with the oil prices, with the natural gas prices. Fuel oil is up 12.3% month on month. Gasoline is up 6.1% month on month. Even used cars and trucks, which had pulled back the previous couple months, were back up another 2.5% this month. New vehicles are back up 1.4%. There's no like convenient way to slice this, and I know I talk about it a lot, but the inflation is a big deal. But I think the biggest takeaway here is that the inflation is outpacing wage growth. We kind of touched on this a couple weeks ago, and I was talking about how it's so important for you to invest, for anybody to invest into the stock market, because if your money is sitting in a bank account, you're quite literally losing money in an inflationary environment. And here, I mean, in the CNBC article, they said it's outpacing wage growth. Inflation is outpacing wage growth. So it's almost like pressuring people to get a better and better return on their investments just to make sure that they're actually progressing financially. This whole situation is kind of scary, and I think a lot of this has to do with the ridiculous overvaluations in the stock market that we're seeing with companies like Rivian going over 100 billion. People just want to ride in on the quote-unquote easy gains, because how else are they going to make money in this environment? There's very few good, very few actually attractive opportunities right now. I still think the best thing to do with money is just park it in a broad market ETF. If you don't know anything about investing, just stick it in VTI and walk away, because at the rate we're going, the stock market is the only way to actually make money right now. I guess cryptocurrency too. I guess if you want to park it in Bitcoin or Ethereum, although Ethereum's at like an all-time high, Bitcoin's at an all-time high. I don't know. What do you do? What do you do with your money? Buy used cars, antique cars. Maybe they're a better hold of value right now. Some wine, you know, build a wine cellar. That's a deflationary asset by nature. It's not like there's more old vintages being produced, so I guess wine. I'm going into the wine investing business. And this is perplexing. Coming off the back of the CPI report, workers quit jobs in record numbers as consumer sentiment hits 10-year lows. The University of Michigan Consumer Sentiment Index tumbled to 66.8 for November, representing the lowest level in 10 years. Inflation concerns weighed on consumers, with 1 in 4 reporting scaled back standards of living. A separate report showed that more than 4.4 million workers left their jobs, a fresh record. It really seems like those two statements cannot both be true, because they're almost at odds with each other, where you have people scaling back their spending because they're scared, and that actually puts an emphasis on stable income, on maintaining stable income, because you need to secure some type of income. But then you also have record numbers of people leaving their jobs, like electing to leave their jobs. And it's not like these are seasonal hires that are leaving. We haven't even reached that period. That doesn't happen until January. So what's going on here? How is it that people are scared and still leaving their jobs? Is it just like they're hopeless at this point? They're throwing their hands in the air and they're like, oh, whatever. I guess I can't eat. I can't work. Whatever. It doesn't matter. I don't know what's going on with the mentality here, but this just seems wrong in every possible way. Let's take a look at the upcoming earnings for this week. A couple of companies that I'm actually excited in, Walmart and Target together, should actually be reporting really good earnings, because from what I've been reading online, a lot of the holiday shopping has been done in advance because people were worried about bottlenecks and supply chain issues and not getting their Christmas presents. And Walmart and Target should be reporting their holiday earnings effectively a quarter early, since a lot of the holiday shopping seemed to start in about August or September. So I'm expecting Walmart and Target to just blow the roof off their earnings. Freight Car America and something like Starbulk Carriers, they should be reporting backups and maxed out revenue based on their carrying capacity. Lowe's and Home Depot, again, should be really, really good. Anytime you have a situation where people are fearful in the economy, they end up tending to focus more on home repairs to increase the value of the primary asset that they have, which is their home. Same thing with a company like Advanced Auto Parts. I expect Advanced Auto Parts to do better in an a high inflationary environment, especially when new car prices and used car prices are so high. People are going to be more prone to repair their own vehicles rather than just getting an entire new one. A lot of Chinese companies reporting this week: Alibaba, Bilibili, QIY, NetEase, Toyu. Lucid is another one of those EV companies with just an insane valuation. And oh my gosh, the Lucid cars are just gorgeous, but the company's valuation is crazy. So I'll be interested to see if this has any connection with Rivian or with any of the other EV run-ups that we had. Like maybe if Lucid reports disappointing earnings, then all of the other EV companies end up falling off because Lucid is so speculative. On Wednesday, we have two semiconductor AI companies, NVIDIA NVIDIA and Baidu. Baidu, of course, being Chinese, but it holds a ton of AI patents, and NVIDIA is making semiconductors that actually work really well with AI applications. But one company that I want to talk about a little bit is Oatly. Now, this is the most misleading earnings chart that I think I've ever seen on Yahoo. Take a look at the y-axis points here. I don't know if you could actually see it, but it's -10, -10, -10, -10, -10, -9, -9, -9, -9. So we actually have like 5 data points for a single cent. So on their last earnings report, it looks like they had a huge beat on their earnings, but it was beat by 1 cent. The pundits thought that they were going to lose 10 cents a share, and they ended up losing 9 cents a share. But because of the scaling on this chart, it looks like they had a massive beat on earnings. Misleading charts. Make sure you look at your axes, kids. And if we look at the overall chart for Oatly, man, it is ugly. It ended up peaking after IPO mid-June about $29 a share. And since then, we've been just kind of nosediving. We're down to about 11.13. And the scary part is about this drop is that it keeps on making lower highs and lower lows, stepping its way down. And it looks like if it follows the same time pattern, this week we should rise a little bit for about a week and then just fall off and make lower lows. And it looks like we're going to be coming in around 920 for the next bottom. And if we go to the financials for Oatly, the revenue is increasing, but the cost of revenue is actually outpacing the revenue growth, where they're putting increasingly more into the cost of revenue for diminishing returns on their revenue. That's not a good sign. Net income keeps increasing in the wrong direction. We're heading more and more negative on the net income. If we take a look at the net increase in cash and cash equivalents, all of the money that they got was from the financing from the share sales on their IPO. Past that, they didn't really have much. They needed to IPO when they did. This company is much more reasonably priced than something like Rivian. With Oatly, we're sitting at like an extrapolated 600 million in revenue for the year on a market cap of about 7 billion. So it's a little over a 10x there, and we can actually see some justification there. But that being said, it's still a bit overvalued. I would not be surprised to see the price trend upward this week, maybe flat to up, and then starting next week, we start to drop off and find those lower lows. I like Oatly. Oatly oat milk lattes are the only drink that I can actually drink at Starbucks and enjoy. I like drinking Oatly's product. I guess I just don't like the valuation of the company. And I feel like this is becoming a common theme when I'm talking about this. When I talk about Monday.com, I like the product. I don't like the company's valuation. When I talk about Lucid and Rivian, the cars and trucks are gorgeous. I don't like their valuations. When I talk about Oatly, I love the product. I think Oatly oat milk is delicious. It's much better than almond milk. It's not even close, but I don't like the valuation of the company. And if this price does end up dropping and settling somewhere around the $7 to $8 range, I will be opening up a position in Oatly because I think that is pretty close to a fair price for what it is, especially with a lot of headway being made in the meat-free options, in the vegan, the vegetarian options on menus and in stores. Stores are carrying more and more of these products, so I can definitely see why Oatly is an attractive investment. All right, everybody, that's it for me today. I hope you did enjoy the video. As always, if you want to support the channel, please check out my Webull referral link below the video. If you sign up for an account, deposit $100, you get a free stock, I get a free stock, everybody wins. Also, if you enjoyed the video today, please be sure to like the video, subscribe to the channel, and if you want to be alerted to all my content as soon as it comes out, make sure you hit that notification bell. All right, everybody, thanks a lot. Stay safe. Good luck investing, and I'll see you next time.